Barry, your general playbook right now involves waiting for the Fed to get kicked or forced back into acting and then getting more aggressive, at least on equities. How did the webcast today move you in terms of the execution of that playbook?
No change, Carl. We felt that deflationary shock is usually necessary to get the Fed to do incrementally more, and what the Fed and the Treasury have already done is reflected in the price. So since that April 30th downgrade to a neutral view, we see the market trading in a 5% range of around 2,900 in the second quarter.
Does that mean you don't think the Fed will need to act, or that there will be some sort of inhibitions or obstacles in the way of them putting further policies into place?
Right now, reflation and early reflation always feels like growth until it becomes problematic years down the line. Reflation is missing. We've had a reduction of volatility. We've had spreads come in. We've had backstop. We've had fiscal. But we haven't had reflation. And reflation is a critical element to get the market to move higher from this level. So if I see a deflationary shock, I would expect a significant further fiscal monetary action in tandem. But I haven't seen that shock yet, so I'm just standing aside, watching for reflation signals, and we're neutral after having had a big rally in the prior quarter.
That sort of market sort of is indicative of the market's general stance right now, is that we've seen policy kick in. We're waiting for results on these reopenings. We're waiting for caseload data to change, if it's going to change. How do you put all of that into some framework, given how negative the Fed chair appeared to be this morning?
Well, you can't. I mean, there's a. Oh, I'm sorry.
No, go ahead.
Go ahead.
Was that for me, Carl? Yeah, no, yeah. I don't think you can, Carl. I think there's just too much uncertainty here. There's many different paths you can go down. And I think the message from Fed Chair Powell was, given that uncertainty, it makes sense to err on the side of being aggressive as a policymaker, both at the Fed, and of course the Federal Reserve is, playing all its cards, doing everything it can. But he also sent a strong signal to lawmakers that their job is not over in all likelihood, that they're going to have to come up with another fiscal rescue package. Maybe this thing turns out better than anticipated. Maybe we get a vaccine earlier. Maybe there isn't a reintensification of the virus, but I wouldn't plan on that. And because if you go down the darker path, the economy will evaporate, will be in a depression, our fiscal problems even worse, and there won't be a policy response. So better to be aggressive right now.
Yeah, I think that was, Mark, the most important thing that he said, which was a direct call for Congress to do more than the $3 trillion they've already done. I mean, how do you think that's going to go down? Usually, Fed is careful not to wade into fiscal policy. He said that. He said it's actually quite the opposite relationship, that Congress oversees the Federal Reserve. But how do you think that call is going to be heard? And do you think it's going to matter and actually push Congress in that direction?
Well, I mean, this just highlights how significant a threat he thinks this is. I mean, for him to actually go down this path and tell, explicitly to lawmakers, you guys got to do more is really unprecedented. And I think signals just how nervous he is about this, and also how nervous he is about the ability of the Fed to do much more going forward. Now, how it goes down, I'm sure you're going to get, some criticism, and a lot of folks that think it's a good idea. But I think from an economic perspective, put the politics of it aside, I think it would be very prudent for lawmakers to put another rescue package together, because here's a very important point. They've put forward a lot of money, a lot of support, almost $3 trillion, but almost one half of that is already in the economy. And at the current trajectory, by July, August, all of that money will be in the economy. And then if you get on the other side of the business reopenings, we don't have a vaccine and the economy goes sideways, that stimulus is gone. And then we got a problem. The economy is going to really struggle. So I think lawmakers have to work now to prepare for what the world looks like on the other side of these reopenings.
Mm-hmm. He also, Barry, painted a pretty stark picture of who's feeling the most economic pain in this country, pointing to a Federal Reserve survey showing that 40% of households with less than $40,000 in income included someone who has lost a job. So what does that mean? Are there investment implications of that that stark contrast between high income and low income households and how they're feeling this impact?
I think there's fear all around. If you look at it, we've had fairly prolonged and increasingly unnecessary full shutdowns. Consumers and businesses have been paralyzed with fear. If you look at the media coverage of the virus itself, if you look at the litigation risk for business. So we have a general state of economic paralysis right now. It's going to turn into rigor mortis if we're not careful. And if you think about the S&P, it, since World War II, has always bottomed 4 months before GDP inflected upwards in a recession. 4 months. That's the pretty consistent. And so we need to see recovery from about the 1st of August onward. And if that date slips, the market's going to slip. And so that's why we're using this second quarter period to monitor fairly intensively every single data point that we can find on the success towards a more reflationary, reopening, regrowth outlook. And I haven't seen much of that so far, so I feel good about the position.